I think it is clear that the collapse of SVB, problems we've seen in the banking sector, are a symptom of rising interest rates. And really, that was inevitable. That is a channel through which rising interest rates transmit into the financial sector. And it's likely that there are other vulnerabilities out there, maybe in small banks, which are far less regulated than the larger ones, maybe also in the non-bank financial institutions, such as open-ended funds. It's very difficult to see where the next shock is coming from. But I think policymakers are in a relatively good position to deal with them. They've learned from some of the mistakes of the global financial crisis that rapid action is very important, that regulation is very important. So let's hope that there aren't too many skeletons in the closet. It was unsurprising that we underestimated this inflation. It was very difficult to see coming in advance, given just how low inflation had been for so long. The fact that we had this energy shock was clear, but the idea of it feeding through into wage growth and to core inflation in the way that it has done was very difficult to foresee. Now, central banks have to respond to that. Their target is to bring inflation back down to 2%, so they need to do all they can to do that, and the tool that they have to do that is obviously the interest rate. Now, it's quite a blunt one, and it can cause some difficult distributional effects. It's very difficult for ordinary people, but that is the key way that they have to bring interest rates down, and it needs to be done quite quickly, because otherwise inflation expectations get out of control. You end up in this 1970s style wage price spiral, which is even more damaging than the high inflation that we're seeing at the moment.